Strategies for maximizing your after-tax returns. Now, it's a good article from Vanguard. It's a quick and easy one, but we're going to dive into it even more deeply because this is big. It's a big deal. All right. When markets are volatile, it's helpful to refocus your clients on things they can control. How money is invested and how income is generated are both areas in which you, Mr. Client, yourself, have control. They say you should take advantage of tax advantage accounts. Yeah. Use a Roth strategy, multiple Roth strategies. Roth 401k, Roth IRA. HSAs, great. And we're going to fly through this because there's a big one I want to talk about. Options for withdrawing unexpectedly from retirement accounts. Well, borrow from your 401k. It's tax-free. It's double tax. No, it's not, man. The money comes out tax-free. The money was tax deferred going in. It comes out tax-free. When you put the money back in, you're not getting a tax deduction because you've already got the tax deduction. It goes in after tax because you already got it out tax-free. It's not double tax. Literally, it drives you up the wall. People say, it's double tax because you don't get a tax deduction reinvesting it. Yeah, because you took it out tax-free. One of the biggest mistakes you can do, in my opinion, is to carry big credit card debt while you have a 401k or 403b that you have access to. It doesn't make any sense whatsoever. All right, let your clients' needs. All right, right here. Making asset, this is what I want to talk about. Asset location decisions with taxation in mind. It's dark in here, man. A diverse asset allocation plan is essential for smart investing, but certain asset classes are better suited in tax-deferred accounts and other in taxable. Portfolio construction should consider the tax ramifications of various asset classes and the tax treatment of accounts. All right, so remember, stocks, long-term capital gains are taxed as preferable. Qualified dividends, taxed as preferable. All right, long-term capital gains and qualified dividends are taxed as preferable. All right, you get a tax benefit relative to ordinary income, which is interest. I probably should put this over here, actually. But anyway, so stocks give you qualified dividends and long-term capital gains as long as you held it for over a year. Those are taxed 0, 15, or 20. That's it. And if you're well above a certain amount of income, it could be 23.8 for the net investment income tax. Interest income or short-term capital gains is taxed as ordinary income. Ordinary income, every time. Again, my Barfield Financial, Chris Barfield, I'm going to use his shirt to wipe my thing here. All right, ordinary income is always greater from a tax perspective than preferable income. All right, ordinary income tax, I should say, is always greater than preferable income tax. Again, preferable income tax is qualified dividends and long-term capital gains. Everywhere and all the time. You'd much rather have preferable than ordinary income. Now, people are going to say, but tax-free is greater than them all. And I guess, which is true to some regard, right? So we got tax-free is, well, I'm going to mix, is greater than preferable in terms of favorable to you, which is greater than ordinary income. Tax-free. So I'm kind of changing the equation here a little bit, but tax-free is always better than preferable, which is always better than ordinary income. So you think. So you think. And that's what we're going to look at here. All right, so check this out. So remember, ordinary income is always tax heavier than preferable income. All right. Tax-free is better for you than preferable, which is better for you than ordinary income. Inherently, A is greater than B, B is greater than C, inherently A is greater than C. So tax-free is better not only than preferable, but ordinary income. Hope that makes sense. Tax-free being a Roth, and there's something else out there we're going to talk about. First, holding bonds and investments that generate interest should be in qualified accounts. That would be your IRA, your pre-tax accounts. All right. Now, you could make an argument for Roth IRAs as well. In this case, yeah, I would. Roth, you should, because now the interest rates are much, much higher than they were before. I would put Roth in my, I would have no qualm having bonds in my Roth. Before, no, because the interest rates are too low, but now it's certainly. But you don't want bonds in a taxable account because it comes out as ordinary income. It's not preferable. Locate actively managed stock accounts and tax-deferred accounts, be it a Roth or a pre-tax IRA or 401k. Finally, only once fixed income accounts and actively managed accounts are in tax-deferred do you allocate the remaining shelf space in those pre-tax accounts to equity holdings. So what I have right now is I have a Roth. Hey there, Growlies. I got 3 types of accounts. Traditional, Roth, tax, post-tax. All right. So in my post-tax account, I have VTI because it doesn't pay any long-term capital gains because it's an index fund from Vanguard. It's very, very cheap. It's not actively managed. It gives a little bit of capital gains, but not much because I don't have that much money. I mean, I'm building it, but I don't have that much. In my Roth, I have my Wellington. In my traditional, I have my stock funds. Or my Roth, I have my Wellington stock. Yeah, in my and stocks. In my traditional, I just have Wellington. All right, but this will be moved over to this next year anyway, so it doesn't matter. But anyway, so what I have is I have my Wellington and I have a couple individual stocks in my Roth, and then I have VTI in my brokerage account. Now, I don't have any municipal bonds because I don't believe in them. Now, that doesn't mean you shouldn't own them, but I don't want any municipal bonds. And a lot of people, what they'll do is they'll put municipal bonds in their brokerage account. I want to share with you why you shouldn't do that. There's an intermediate tax-exempt fund from Vanguard. Right now, I think it's paying like 3.5 is the 30-day yield. Let me just double check. Yeah, 3.43. All right, so that's the last 30 days it yielded 3.43. So that's what they paid over the last month. All right, so if you're in a 25% tax bracket, what you do is you take the 3.43, divide by 1 minus your tax bracket. So it'd be divided by 0.75. And I don't have my, why do I keep forgetting my calculator? Dagnabbit. So 3.43 divided by, and a lot of people do this. They'll put this in a brokerage account, and it's not a good move. Divide by 0.75. So that would give them an after-tax or tax equivalent yield of 4.57. All right, so you get 4.57 tax equivalent yield if it's in a brokerage account and you're in a 25% tax bracket. That's not bad, but don't do that. And I'm going to share with you why here. What you'd want to do instead is you'd want to do, we're going to go to Vanguard Intermediate Corporate Fund. Intermediate right there, corporate. Intermediate term corporate. And that's paying more. All right, so intermediate term corporate, what we want to do here, this is yielding a 5 or something like that, I can't remember. Yeah, 5.31. So what we want to do in your corporate, so you're getting 5.31, all right? Let me show you what I'm talking about. So you don't want municipal bonds. You want the 5.31 in your IRA because that's all tax-free or tax-deferred until you pull it out as ordinary income. If you have the 5.31 in a brokerage account, you're paying ordinary income on it anyway. All right, so don't do that. What we want instead is we want this 5.31% in our IRA, and what we want is in our brokerage account, we want VTI. Because the interest, the dividends you get off VTI are qualified dividends. They're always taxed more preferably than the interest income you get off a bond. All right, remember, ordinary income is always and everywhere taxed higher than qualified dividends. So VTI pays us qualified dividends, and if you sell it after holding it a year, it's taxed as long-term capital gain, which is always better to you than ordinary income of a bond. All right, now this right here is that 5.31 that comes out as ordinary income is still better than the municipal bond fund that you could get, because the alternative would be you'd have a municipal bond, which is where I think we said 4.5 is a tax equivalent yield, and a brokerage account. Now, the problem with that, though, 4.5 in a brokerage account, you could have that not in an IRA, I should say over here, 4.5, is that what's happening here is now if you have the VTI in your IRA instead, the VTI comes out as ordinary income. Do not do this. Do not have municipal bonds in a tax-free account, because municipal bonds are tax-free. Because then put your brokerage account, and then put your investments, your stocks in an IRA. What's happening is you've changed this, which comes out as preferable, and you've made it taxed as ordinary income. You've given yourself a tax hike. Don't give yourself a tax hike. Have your brokerage accounts, have your ETFs in it, and your IRAs have your bonds. Anything that comes out of an IRA is forever going to be as ordinary income, which is always taxed more favorably to the IRS and less favorable to you as qualified dividends or long-term capital gains. Secondly, on any kind of bond, you're not going to get any step up in basis, man. All right? And a step up in basis simply means if I put $50 into VTI and it grows to $150, at my death, my heirs get $150 completely tax-free. There's no long-term capital gain, no nothing. It's called a step up in basis. You're not going to get that in a bond because a bond always matures at par. So a bond is always issued for 50, it's really 100, and it matures at 100. Now, there could be a little bit where you die will have a little bit of gain, but it won't be much, especially if you're holding it for the long term. There is no capital gains in bonds. There isn't any. Just stop that. People say, no, there's not. There's no capital gain in bond. There is capital gain potential in stocks. I mean, just look at the last 25 years, man. You bought X amount of dollars of Amazon, or hell, Apple in 1997, you're freaking sitting on a huge capital gain. You die today, that's all going tax-free to your kids. No municipal bonds doing that. So not only are you now moving your Apple stock into an IRA, and it's coming out as taxed as ordinary income, there's no step up in basis on your municipal bonds if you had it in a brokerage account. Don't do that. Always and everywhere want ETFs, stock accounts in your brokerage account, and corporate bonds. If you're going to have bonds, have corporate bonds in an IRA. Don't do it the other way. Do not do stocks in an IRA and municipal tax-free municipal bonds in a brokerage account. It doesn't make any sense. All right. Love your thoughts. We'll see you. Oh, by the way, don't forget to sign up for my newsletter, my email list on my website. You don't even have to go to my website. You can go to Doobly-Dook here. Just sign up for my email list. I send 2 emails a week or something like that. 2 weeks. Sometimes I send more. Sometimes I send less. I didn't send any in like April. A couple months ago I didn't send any. This month I sent a bunch. So don't forget to sign up my email list on the first thing in the description. All right, we'll see you.